And we are in Vienna covering the LBMA conference in collaboration with the CME Group. My guest today is Bart Melek, Head of Commodities for TD Securities. Bart, thank you so much for being with us.
It's great to be here. Thank you.
Well, TD recently updated their gold forecast, as did many banks. So let's start by talking about your revised gold forecast. Now, you said that you see some strength in gold this quarter, but then it might take a bit of a dip in the first quarter of 2016, and then it would regain some strength. So could you elaborate on your forecast, Bart?
Sure. It's a little bit convoluted, but we did upgrade our forecast in the short run. And that's very different than what we did for the base metals. We overall have downgraded the forecast there. The main reason why we think gold has a little bit of upside, at least over the next couple of months, is related to U.S. monetary policy. We think that for the time being, the market is going to get increasingly comfortable that the U.S. Fed pulls the trigger on rate hikes not until March or maybe even later. And in fact, with the way economic data in the U.S. has been tracking, that there may not be an increase next year at all. And that means the U.S. dollar likely slumps and interest rates stay low, maybe even head lower. That's good for gold. Okay,
so what price range would you be looking at?
At this stage, we're looking at a high of maybe 1225. We're on record as saying that in the near future, and that was a while back, we would see 1180. We got to around 1190, and at this point, technically, 1225 is very much within our target.
Bart, let's talk a little bit about short covering. We've seen quite a bit of it in the gold market over the past 2 months, 2.5 months. What prompted all of these shorts to exit their positions, and what could the repercussions be for the industry?
Well, first of all, we had fairly elevated short positioning. Broadly speaking, in essence, people were betting quite heavily that gold is going to slump, probably below 1,100, maybe even below $1,000. And that was predicated on the assumption that the Fed is going to pull the trigger almost immediately. Many market observers thought September 17th was the day. That didn't happen. So what is likely that we're seeing is people got stopped out, and others are no longer sure that a one-way bet is the way to go, so they have to pull back their short exposure, and they covered.
All right. So what metal do you like heading into 2016? Which one do you think is going to fare best?
I would have to say palladium. Palladium should benefit from the migration from diesel to gasoline engines, and this is following the VW issue. And also, I think gold towards the end of next year does fairly okay, mainly because we'll find out that any move by the U.S. Central Bank is going to be very much muted. So stronger demand, tighter supply-demand balance, and I think monetary conditions helping palladium out.
Bart, thanks so much for your thoughts today.
It was my pleasure. Thank you.
And thanks for watching our coverage here in Vienna, covering the LBMA conference. We'll have more for you throughout the week. Thank you for watching.